What's up, guys? Welcome to this channel. In this video, we're going to basically go over the introduction to mortgage. So if you're brand new to real estate, brand new to mortgage, this will basically hit the topics of everything. We'll talk about basic terminologies. We'll talk about the team that will help you. In addition, we will go over the process very briefly so you can understand. So sit back, relax, grab a cup of coffee or tea, and enjoy the video.
All right, so let's get started with introduction to mortgage. Now, what is a mortgage? Consumerfinance.gov defines a mortgage as an agreement between you and a lender that allows you to borrow money to purchase or refinance a home. Now, the difference between a mortgage and like a credit card is that a mortgage has longer terms, meaning that you can see it anywhere from 15, 20, 25 to 30 years. So yes, purchasing a home is a long-term commitment. Now, here are a few basic terms. Now, don't worry if you don't catch all of it. You don't need to write it down because we're going to go through each and one of these one by one. So let's first start with FICO scores. Now, the FICO scores are just your credit scores from 3 different credit bureaus. Now, out of these 3 credit bureaus, we take the middle score. So if you're a solo borrower, we would take your middle score, and that one would be 710. Now, let's pretend you have multiple co-borrowers, whether that be family members or that be your spouse. We take the lowest middle credit score. So let's say this looks like your credit score, and this is what your co-borrower looks like. So your co-borrower would be at 680 for their middle score. So that is the FICO score that we would base this mortgage around. Now we're going to go ahead and move to the next term. This term is called equity. Now, equity is the value of the home minus the loan amount. So for lenders like to see higher equity because you would be considered less risky. Now, the next 2 terms that are coming up are the biggest cost for you when purchasing a home. And that first one would be the down payment. Now, the down payment is just the amount you put down to secure the property, and the rest of the value of the home is financed. So there's different types of down payment you can do. That all just depends on which program you're on and how much money you save. And typically, anything below this, like there are loan programs out there that you can put no money down. Now, we'll go ahead and touch on those programs in another video, but for right now, let's just use 20%. And the next cost would be closing costs. Now, closing costs can be made up of like origination costs, application fee, discount points, credits would be in here, closing costs, just county transfers, escrow title fees. Again, these are just really just real basic idea costs. They're not really in depth. So closing costs, just a rule of thumb, what we do is we take the value of the home, which was about $300,000, and we just multiply it by 3%. And that's what we try to do when we just calculate closing costs. Yes, I know it's just way high up there, but for me, I'd always like to overestimate what closing costs will be because it's better than underestimating. Now, the next thing we're going to talk about is your mortgage payment. Now, your mortgage payment is typically PITI, which is your principal, and that's your loan amount. The interest, which is the interest charges. Tax, which is county and city tax. Insurance, your homeowner's insurance. And here in California, we have earthquake, flood, and fire. And for those people who put less than 20% down on their home, they're going to probably get hit with mortgage insurance. Now, mortgage insurance is there to protect the lender because your LTV is less than 80%, but we'll get into what LTV is a little bit later. And this all equals to PITI or PITIM. You can also call it the housing expense. Now, as we're moving on to the loan-to-value ratio, the loan-to-value ratio is the total loan amount divided by the value of the home, which we just call short LTV. Now, the last thing that we talked about was anything less than 80% LTV would have mortgage insurance. So, yes, you would be deemed more risky, and that's why the lender wants you to pay insurance to ensure that you would be able to pay that loan. Next one we'll talk about is debt to income ratio. There are 2 debt to income ratios. One would be the front end, and that would be your PITI divided by your gross income, and that is also called a housing expense ratio. Next is the back end DTI. The back end DTI includes your PITI with your car payment, your credit card, divided by your gross income, which comes out to your back end DTI, which is your total expense ratio. Depending on which loan program you use, would depend on what is an acceptable back end DTI. Again, we'll get more into that in another video. So now let's go ahead and meet the team. Of course, the first person that you're going to meet is the LO or the MLO, the mortgage loan originator. That person will get all your information put into a computer and discuss interest rates and discuss what the costs are going to be. Not all LOs will use a loan processor. That person could end up being the MLO, but typically in our office, we do use a loan processor. The loan processor takes all your information and gives it to the underwriter. She also, or he or she, will also go get information from title and escrow, and she basically helps out the loan officer as much as possible. Now, the underwriter is the one who works for the lender, and they just check the validity and make sure everything is correct. They will also ask for different things to improve stuff, but hey, that person is not an enemy, but we just got to make sure we do what we need to do to make sure the underwriter is happy. And if you were sent here, more likely you already have a real estate agent, and your real estate agent basically wants you to understand the process. Now we get to the loan application. Now the loan application, you just need to put in your personal information. That'll be your first name, last name, social security number, date of birth, email, where you lived at, and that's also for your co-borrower as well. Additional documents that you guys are going to need are a copy of your ID and social security card, 2 recent pay stubs, 2 recent monthly bank statements, 2 years W-2 or personal tax returns, and if you're a business owner, they're probably going to ask for 1 to 2 years of business tax returns and possibly a profit and loss statement. If you want more information on this, again, I'll touch on it in another video. If you want information right now, just go ahead and just leave a comment and I'll get back to it as soon as possible. Now the pre-qualification process. I highly, highly recommend you guys do this pre-qualification process before you guys even look for a home, because it would really, really, really save time and effort, so that way you and your realtor can go find the right home that fits your budget. So now you would get all your information and give it over to the loan officer. Now the loan officer will go ahead and go put all your information into his file, probably pull a credit report, and run it through something called an automated underwriting system. If everything comes back good, they get an approval letter, and that pre-qual letter gets sent over to your realtor. And then from there, you and your realtor will go and find a property. Once you guys go out and find a property, locate a property, and your seller accepts, then we can move to the main process. Now the process starts with the realtor getting all the purchase documents and sending it over to the loan originator. Now the LO would take all that information, update your file, gather everything that he needs or she needs, and send it over to the loan processor. Now the loan processor would take all that documentation and upload it over to the underwriter. There's more to it than just this, but just know that this is just a brief overview. Now the underwriter would get all that information, make sure everything is correct, and send it over for funding and recording. Congratulations. You guys are now proud owners of a home. Just a few quick tips to ensure that your loan funds and you don't have any issues. Avoid large purchases if possible. That includes car payments, boat payments, something that will knock your debt to income ratio up. Avoid using credit cards if possible. Same reason. You don't want to ruin your debt to income ratio. Save money. Remember, you need to save up for a good size down payment, 20% if possible. If not, again, there are programs out there that allow you to put 3.5% or even no money down, but still you need to have money for closing costs. If you're an hourly employee or even a salary employee, remember, try to work as many hours as you can, or at least your full shift hours, because less income means a higher DTI.
Hey, congrats on making it to the end of the video. Now that you guys have an understanding of mortgages, you guys are ready for the next step. If you have any questions, please comment down below and I'll do my best to get to them all. If you found this video interesting, please hit the like and subscribe and hit the bell notification for any future videos that will come along. Thanks a lot, and I'll see you in the next one.